All right, everybody. Well, happy Tuesday morning. Appreciate you jumping on today. We had to move this off of yesterday to today, so I'm probably have a little bit different crowd than normal, but um, we'll get the recording and everything up. So I'm going to jump right in. I'm going to share my screen. Got two interesting topics to share with you guys today. So um, obviously, the big market driver for the past few months has been the war in Iran. And what's interesting is over the weekend, there was a little bit of escalation. Israel and Lebanon and Iran kind of got into it a little bit, and it seems like things have kind of calmed down a little bit since the weekend on that front. But if this was 2 weeks ago, 4 weeks ago, or 6 weeks ago, and there were some tensions that arise that maybe caused to like have a ceasefire kind of be called into question, what would have happened to oil prices? They would have surged. That would have led to fears of inflation. That would have pushed mortgage rates higher. And if we look at the charts, yesterday, the bond market was down a couple basis points, but really kind of a non-factor. So it's interesting that if what happened over the weekend happened 2, 4, 6 weeks ago, much different outcome than what we saw, which was the market kind of shrugged it off. And so what that tells me is that the market believes that the conflict is winding down, that we're probably headed towards a ceasefire, that oil prices will start to slowly settle. That doesn't mean it's going to be a fast end. It doesn't mean that you're going to see inflation drop overnight and rates go down overnight. But at least it means that market expectations, and the market moves not based upon news, the market moves based upon expectations. And that tells me that market expectations are that things will kind of start winding down here over the next days, weeks, and months. Um, the other big news from last week is we got a really strong jobs report last Friday, stronger than expected.
And can you repeat? Can you please repeat?
And what was interesting was one, that it was strong, but two, that what sectors of the economy were strong. So before I kind of reveal where the jobs were created. What do you all think happened with job creation in the technology space? Do you think technology job creation was good or was weak? If you guys have an opinion on that, throw it in the chat. So tech job creation. So we got a week here. I think I saw one. Okay, and so that's the right answer, Jen, is it was weak, right? And why was tech job creation weak? AI, right? Companies are investing billions and billions of dollars into implementation of AI systems. They're spending the same amount of money, but they're spending it on AI development versus on humans. Okay, now let me give you another sector. How about healthcare? Was job creation in healthcare strong or weak? Okay, what do you guys think there? Okay, and so we got a strong. All right, so and that's the right answer, right, Jessica? Did you guys already read this update? Um, so strong in healthcare, and again, if you think about it, we have an aging population. We have boomers getting older. Healthcare costs rise the older someone gets, and over the past 10 or more years, and probably for the next 10, the healthcare sector of the economy is going to continue to grow as it's needed to kind of care for an aging population. Um, but overall, there was 172,000 jobs created right here, kind of doubled expectations. But again, the market moves based upon expectations, not on the news. So, strong jobs report, economic growth also sometimes leads to fears of inflation, and inflation is what moves mortgage rates. So, um, I'm going to tell you why I don't think mortgage rates sold off on Friday in a second here, and kind of give you my opinion, which is a little bit contrarian, kind of outside the box. Um, okay, so that's one piece of news. We'll circle back to this. We have a Fed meeting coming up. The first Fed meeting with Chairman Warsh is next Wednesday, the 17th. You want to turn into CNBC or Fox Business. You want to hear his testimony when he goes in front of Congress. It'll absolutely be a market mover. The Fed's not going to do anything next week, but what he says will move the market. And so 2:15 or so next Wednesday is usually when he's on live, if you want to block it off on your calendar. On this Fed CME watch tool, so 97% of those polled are expecting no change in the Fed funds rate. But what gets interesting is what do people think will happen in July, August, and September? So right now in July, not some expectations of a Fed rate cut. So 88% of those polled thinks the Fed funds rate will be the same in the 350 to 375 basis point target. 10% of those polled in this survey think the Fed's going to start hiking in July. If we push that out to September, now you're at 38%, right? 35 think it's going to be one cut, and then a few people think they'll be in a second cut by September. And if we run it out to October, you're 50% or more think there's going to be a Fed rate hike, not a Fed rate cut by then. So that's a big shift from what we were talking about at the end of last year and earlier this year. So what do you guys think the market wants? Do you guys think the market wants a hike, or do you think they want to cut? Okay. What does everybody think? Do you think the market's rooting for a hike? I'm gonna I'm gonna say I think normally the market would like a cut. I think the market wants a hike. And here's why I think the market wants a hike. What is worse, running away inflation or weak economic growth? Okay. Runaway inflation. Okay. Because it hurts personal finances, it hurts business finances. Inflation is more painful than weak economic growth. And we all saw that from 2022 through kind of like 2020, end of 24, early 2025. When inflation spiked, that's more damaging than weak economic growth. So I think the market wants a hike. Okay. And normally a hike would be bad news, right? And so let's look at the Fed funds rate chart here. So this black line is the Fed funds rate. I'm going to come back to this in a minute. And so why was the Fed hiking from 2022 through 2024? They were hiking because inflation got out of control. And so they were hiking, and that was bad news, right? They were hiking because they had to, because inflation got out of control. But if inflation gets out of control, that's worse than weak economic growth. And so would a hike potentially slow down economic growth? Would businesses not love it? Yes, businesses want to borrow money cheaply to expand. But inflation's worse. And so I'm going to circle back to that in a minute. But I think we're more likely to see a hike than a cut in the next few months. Okay. So if we get a hike, and why did the bond market not react negatively to a strong jobs number? I think it's because the market sees a strong jobs number as something that will increase the likelihood that we get a hike. Okay. And mortgage rates typically don't want Fed rate hikes. Like if you look at this chart here, the red line is mortgage rates, the black line is the Fed funds. And if you Google, does the Fed funds impact mortgage rates? Almost everything you're going to see is going to say, yes, they are correlated. Not directly, but pretty close to it. And while that's accurate in most cases, it's not always accurate. And so if you step back and look at a 10-year view here, you can see that the Fed funds rate was drifting lower from like 2019 through 2022. And mortgage rates were, for the most part, drifting lower in that same time. When the Fed was hiking here, mortgage rates were going up. The Fed's cut a little bit here. Mortgage rates have kind of trended lower over the past couple years. And so generally speaking, the trend is that Fed hikes and mortgage rates going up happen at the same time. Fed cuts and mortgage rates going down tend to happen at the same time. But let's look at specific immediate impacts. And if you remember, and we've talked about this some on this call, if you remember at the end of 2024, the Fed hiked three times. They did a 0.5%, a 1/4%, and a 1/4%. So one full rate cut in September, October, November of 2024. And they brought the Fed funds rate down 1% right here. Okay. And at the exact same time, what happened to mortgage rates? They spiked over a full percent. They went from like close to 6 to close to 7 in the short term. And why did the Fed funds cut here cause mortgage rates to rise? It's because inflation spiked. The Fed cut, inflation went up, inflation that happened right at the same time, but it caused a really volatile market reaction where mortgage rates spiked a point when the Fed cut a point. And that gap between the Fed and mortgage rates went in the opposite direction, which is not typical. Typically, big picture looking long term, they tend to move in a similar direction. And so, what do I think is going to happen or has the potential to happen later this fall? If the Fed hikes, I actually think you could see mortgage rates move down. And that's not going to be a long-term scenario, but it could be a short-term scenario. You could see a Fed rate hike in July or this fall that could be followed by mortgage rates moving down. Um, so the Fed and mortgage rates, it's kind of like a cause and effect, chicken and the egg type of scenario. So one tends to move first, and then the other reacts beyond that. So let's look at kind of post COVID in 2021. Mortgage rates were at all time lows. Mortgage rates started going up because inflation surged before the Fed acted. In fact, at the end of 2021, the Fed didn't start hiking until 2022, 6 to 12 months after mortgage rates started going up. Mortgage rates started going up because inflation surged. Um, and so usually one happens first. And so I think what could happen this fall or maybe later this summer is a Fed rate hike could be followed by mortgage rates actually coming down a little bit. And so would a Fed rate hike be good for us? Generally speaking, no. In the short term, yes. I also think it would be good news because um, do you think the market expects Fed Chairman Warsh to do what the president wants? What do you guys think? Like, does the market think that he might do the president's bidding and do what the president wants? I think the market was a little bit concerned, right, that he would, and we want an independent Fed. And so, does the president want lower interest rates? Yes. Does the Federal Reserve directly impact mortgage rates? No. But if the Fed chair Warsh in his first meeting came in and cut, it would be seen as a extreme sign of weakness on his part. So he really needs to come in strong and say, I'm independent. I'm nominated by the president. I probably agree with the president on most things, but I can't cut the Fed funds rate if inflation is spiking. And so I think it would also send a positive signal to the markets that you're going to maintain, even though, each president has handpicked successors and they get to nominate the Fed chair. It's not someone who's going to do exactly what the president wants. I think it could cause the president to get what he wants, which is lower interest rates, which is kind of that contrarian, counterintuitive thought. So anyway, when we hear over the next few months, I think it's really important that it's a way to differentiate ourselves because how many of our lender and realtor competitors are going to be talking about, oh no, the Fed's going to hike the Fed funds rate. That means mortgage rates are going up, affordability is going to get worse, mortgage rates are going higher. That's what most people are going to say. That's what is mostly going to be online. I personally am rooting for a Fed hike because I think it would send a strong message from Fed Chair Warsh, and I think as like who he is, what he's going to do, I think it would send a strong message that he's going to fight inflation, and I think the markets would actually react really positively to it. So that'll be interesting to see what happens over the next few months. I think we'll get a sneak peek of that next Wednesday during his testimony after the first meeting as Fed chair. So they're doing nothing next week. What he says will be market moving, but we want to root for a little bit of what will be considered a hawkish tone. Hawkish means he's willing to fight inflation and kind of stamp it out and make sure it doesn't get out of control, like it did in 2022 and 23 when we saw inflation surge and mortgage rates pushing close to 8%. Okay, along kind of the same tune, there was something I saw on CNBC the other day, and I'm going to link this article in the chat. And if you guys don't have this, just if you're not driving somewhere or you are driving somewhere, you can access this. Just message whoever you work with on our team. We'll get this in your hands. But there was an interesting survey done, and it just kind of was asking like, what's the American dream, right? And so we all know the American dream to be like, you know, have a family, have a good job, but buy a house, right? Like home ownership is the American dream. And so why is that? Because home ownership has typically been seen as stability, like personally, and financial security, right? And there's a higher and higher percentage of people that feel like the American dream is out of reach or homeownership is out of reach. Why do you guys think that more and more people think that homeownership is out of reach? Like, what would cause people to feel like that? So the answer is really kind of expenses and cost and inflation and can they afford it? Affordability, Abby, is kind of the key word, right? Like people feel like homeownership and really most things today, but homeownership in particular is like less affordable than it was. Um, so that's a troubling trend, right? 51% of US adults say the American dream is out of reach. Um, if you remember over the past few months, we've talked a lot about kind of the widening gap between younger and old, stable employment. Um, certain people feel like they're financially secure. Certain people feel like they're far from it, and the middle class kind of squeeze is happening, and that gap is widening. Um, and the way we see that is when we talk to potential prospects. Like some people are very motivated, quick acting, under contract, buy a house, close quickly, sell my house, move up buyer quickly. While others kind of linger around for months or heck, even years sometimes. Like, why would someone contact a realtor, talk to a lender to get pre-approved, and then not buy a house for 6 months or 2 years or 4 years? And why would it linger? It's because they're in that 51% that's feeling a pinch or feeling unsecure or unsettled about making the commitment to buy a house and getting into real estate or move up, as a move up buyer or invest or buy a second home. Um, and so a trend we're seeing right now is the contracts that our team's working on tends to be people that are more recent, someone that contacts a realtor or contacts us, gets pre-approved, and they are actively looking to buy something new, whether it's a first-time move-up buyer, relocation, whatever the case may be. The people that have been around a long time and they're qualified to purchase on paper, but maybe not comfortable in a position to purchase, they're probably in that 51% that's feeling a squeeze. And so, how do we combat that? I think identifying who is more qualified, more serious, more financially secure, more confident and ready today is probably where our effort should be. But then also like who wants to find something that's more affordable, using seller credits for rate buy downs and things that we've all talked about for years. Like, those are tools or tactics that we all have at our disposal that could help us maybe make some of these 51% that feel affordability is a challenge feel a little bit more confident. So, anyway, really interesting survey. Um, Now, the biggest question that was asked in this was, what is your definition of the American dream? And it was like 68% said financial security or financial stability. Okay. And so, answer this question if you guys can in the chat. What is the number one way to obtain financial security or financial stability in America? Like, what's the number one way?
Buy a house.
Okay. Buy a home, right? That's kind of like historically gaining financial stability is investing in real estate, right? Buying a house, putting some roots down, right? And so the message that we need to continue getting out there is if you're looking for financial stability, purchasing real estate is typically the way to achieve that, right? Like that's a big, if you're looking like at a three-legged stool, like a good job, some savings in real estate are probably like the three prongs, right? Um, and so I think that's a message that we need to continue to promote, but we have to acknowledge that a lot of people are feeling a pinch. And so how can we help overcome some affordability challenges, yet still help them achieve kind of the quote unquote American dream, which is financial stability? Oftentimes that's equated with buying a house. And I think the messaging that we get out, like we have tools that we can use to help make things more affordable, I think is a message that is powerful and accurate and something that we need to continue to share. Another thing to continue sharing. But I think anytime there's a challenge, the way to overcome the challenge is acknowledge and then educate, right? And so we have to acknowledge that affordability continues to be a challenge, but then educate on how we can help overcome that challenge. And then, then look at long term, like the long term impacts of owning real estate. Okay, so before we wrap it up, just want to pull the charts back up. So bond market's been on a positive trend, but if we look at the chart for the past 90 days, so you can see the initial sell-off during the Iran war, inflation's, fear spiked, oil prices went up. We had some weeks where things rallied a little bit, where it looked like there might be a ceasefire. Ceasefire kind of looked like it might not happen. The market sold off again, and then we've had some improvement since then, right? And so the longer term trend of ceasefire, no ceasefire, oil up, oil down, inflation fears up, inflation fears down, that'll continue having us have this big, peaks and valleys. And so we need to see kind of some continued movement towards a resolution, which would let us continue like an upward trend like that and not have a sell off where things turn. So although the market kind of absorbed the news over the weekend, that some hostilities kind of broke out, kind of absorbed it and didn't really react. You need to see kind of continued movement towards a resolution. Otherwise, we will see some peaks and valleys. But some good news the last couple of days, and so hopefully that continues this week. Outside of that, not a lot of major economic news this week. I think the market will be pretty flat overall, and everything is looking towards next Wednesday at the next Fed meeting. So we'll talk a little bit more about the Fed next Wednesday, or sorry, next Monday before the Wednesday call. But that's the next market mover that we've got to look out for. Not a whole lot's going to happen the rest of this week. So appreciate you guys jumping on a Tuesday. We will be back on schedule next week on Monday. And have a great day. Have a great week. And we will see you guys next week. Thanks, everybody.